Hey there, future investors. Ever felt like investing is only for people with thousands of dollars sitting around? Like you see those people on Wall Street throwing money around and think, that'll be me, someday? Or maybe you've thought, I'd love to own some Amazon stock, but have you seen those prices? Well, I've got good news. The investment world has changed dramatically, and the barriers to entry have never been lower. It used to be that you needed a financial advisor in a fancy suit to even think about investing. They'd hit you with all these crazy fees and jargon, and you'd walk out feeling more lost than when you walked in. But not anymore. Today, I'm breaking down 5 alternative investment options that you can start with right now, even if you've only got $25, $50, or $100 to spare. We're talking about real, legitimate ways to grow your money without needing a small fortune to get started. No, I'm not kidding. And no, these aren't get-rich-quick schemes. These are legitimate investment vehicles that big-time investors use too, just sized down for beginners like us. We're talking about the same strategies used by millionaires, but tailored for someone just starting their investment journey. Let's dive in. Alright, coming in at number 1, fractional shares, or as I like to call them, the slice of pizza approach to investing. Let me paint a picture for you. You've got $100 to invest and you're eyeing Amazon stock, you've heard all the success stories, you know it's a powerhouse company and you want in on the action, but there's one problem. One single share costs over $3,000. That's more than most people spend on rent. That's where fractional shares come in. Instead of needing to buy a whole share, you can buy just a slice, maybe $25 worth, which gets you about 0.8% of a share. It's like walking into a pizzeria and saying, just give me a slice, I don't need the whole pie. And the best part, it's still real Amazon stock, you just own a fraction of it. You still benefit from the company's growth and any dividends they pay out, just on a smaller scale. Think about it like this. You wouldn't refuse a slice of pizza just because you can't afford the whole pie, right? Same concept here. Now, here's where it gets even better. Apps like Robinhood, M1 Finance, and Fidelity now offer fractional shares with 0 commission fees. That means if you invest $25, all $25 goes toward your investment, no extra costs, no hidden charges. This is revolutionary because it means you can build a diversified portfolio even with just $100 to $200. Instead of putting all your money in one affordable stock, you can spread it across fractional shares of 5 to 10 quality companies. For example, with $200, you could own tiny pieces of Amazon, Google, Apple, Microsoft, and Tesla companies that might otherwise be completely out of reach. You're not limited to just 1 or 2 companies anymore. You can build a portfolio that reflects your interests and risk tolerance. And yes, when these stocks pay dividends, you get your fraction of those too. It's like getting paid just for owning a piece of these amazing companies. Fractional shares are a game changer for beginner investors, making the stock market accessible to anyone with even a small amount to invest. Alright, moving on to number 2, micro-investing apps, where your spare change becomes your financial future. Picture this. You're grabbing your morning coffee and it comes out to $3.75. You pay with your card and you're on your way. But what if I told you that you could invest that remaining 25 cents toward your future? That's exactly what apps like Acorns and Stash do. These apps connect to your debit or credit card and round up your purchases to the nearest dollar, investing the difference automatically. It's like having a little investing ninja working behind the scenes, snatching up those spare cents and putting them to work for you. Buy lunch for $9.30? Boom, 70 cents goes into your investment account. Grab a ride share for $14.50? Another 50 cents invested. It sounds small, but trust me, it adds up fast. Think about it. The average person makes 30 to 40 transactions per week. If each one rounds up an average of 50 cents, that's $15 to $20 per week or $60 to $80 per month, all invested without you even feeling it. That's like having an extra $1,000 invested every year, just from your spare change. Now, Acorns and Stash typically charge $1 to $3 monthly, which might seem counterintuitive when we're talking about small amounts. But here's the thing, they invest your money in pre-selected ETFs based on your risk tolerance. This means you're not just throwing your spare change into a random stock, you're building a diversified portfolio across hundreds or even thousands of companies. And the best part? You literally set it and forget it. This is perfect for absolute beginners because you don't need to make any investment decisions. The app does it for you. It happens automatically in the background of your life. No need to remember to transfer money or place trades. You'll never feel the money leaving your account. It's just those spare cents that you wouldn't have thought twice about. It slowly builds your comfort with investing. You'll start seeing your money grow, and that can be incredibly motivating. I actually started with Acorns 3 years ago, and just from rounding up my purchases, my spare change has grown to over $2,800. Not bad for money I would have never missed anyway, right? Alright, let's talk about number 3, I-bonds, the unsung heroes of low-risk investing. If you've never heard of I-bonds, you're not alone. These government savings bonds don't get much hype because, well, they're not exactly exciting. They're not going to make you rich overnight, and they won't be featured in any flashy investment seminars. But sometimes boring is good, especially for beginners worried about losing money. We've all heard the horror stories of people losing their life savings in risky investments. I-bonds are the opposite of that. They're about as safe as it gets. I-bonds are issued by the US Treasury and designed to protect your money from inflation. Remember when everyone was freaking out about inflation a while back? Well, I-bonds are designed to combat that. The interest rate actually changes every 6 months based on inflation. When prices go up, so does your return. So, while your money is growing, it's also keeping pace with the rising cost of goods and services. Here's why they're perfect for beginners. First, you can start with just $25. That's it, no need for a huge investment to get started. Second, they're backed by the full faith and credit of the US government, making them one of the safest investments possible. It's like having the entire US government vouching for your investment. Third, right now they're offering better returns than many savings accounts. Why let your money sit in a savings account earning practically nothing when you can put it to work in I-bonds? Now, there is a catch. You need to hold them for at least 1 year, and if you cash out before 5 years, you lose the last 3 months of interest. But honestly, that's a small price to pay for such a safe investment. You buy I-bonds directly from the government at treasurydirect.gov, no broker needed, no fees. It's a simple and straightforward process. Think of I-bonds as the training wheels of your investment journey, super stable, predictable, and perfect for money you don't want to risk losing while still beating inflation. Alright, let's move on to number 4, Index Fund ETFs, or what I call buying the entire market for the price of a tank of gas. Now, I know ETF sounds intimidating, but stick with me here. ETF stands for Exchange Traded Fund. Think of it as a basket that holds many stocks at once, and you can buy the whole basket with one purchase. It's like going to the grocery store and instead of buying individual fruits and vegetables, you buy a pre-made fruit salad or veggie platter. Index Fund ETFs specifically aim to track market indexes like the S&P 500, which includes 500 of America's largest companies. These are the companies you know and love: Apple, Amazon, Google, Microsoft, the list goes on. Here's the magic. When you buy just one share of an S&P 500 ETF like VOO, you instantly own tiny pieces of Apple, Microsoft, Google, Amazon, Tesla, and 495 other major companies. Talk about diversification. It's like owning a tiny slice of the entire US economy. Many of these ETFs have share prices under $100, and brokerages like Fidelity and Vanguard offer commission-free trading. Plus, the annual fees, called expense ratios, are typically super low, often under 0.1%. We're talking about pennies for every $100 invested. For beginners, I recommend starting with VTI, Vanguard Total Stock Market, currently around $230 per share, but remember, fractional shares make this accessible. VOO, Vanguard S&P 500, gives you exposure to the 500 largest US companies. VT, Vanguard Total World Stock, for global diversification. Why limit yourself to just the US when you can invest in companies around the world? The beauty of index ETFs is simplicity. You're essentially betting on the overall growth of the economy rather than trying to pick winning stocks. And historically, this approach has beaten most professional investors over the long term. And finally, number 5, real estate crowdfunding, or as I call it, becoming a landlord without fixing toilets. Real estate has created more millionaires than perhaps any other asset class. It's tangible, it's in demand, and it can generate passive income. But traditionally, you needed a lot of money to start. We're talking down payments of $40,000 or more. Not exactly beginner-friendly, right? Enter real estate crowdfunding platforms like Fundrise and Ground Floor, which let you invest in real estate with as little as $10 to $100. That's less than a dinner out for some people. How does it work? These platforms pool money from thousands of small investors to buy apartment buildings, commercial properties, or fund real estate development projects. It's like crowdfunding, but for real estate. As an investor, you own a small piece of these properties and receive proportional returns. You're essentially a silent partner in these real estate ventures. The benefits are huge. You get exposure to real estate without massive capital. No need to take out a second mortgage or drain your savings account. Your money is diversified across multiple properties. Don't put all your eggs in one basket, right? You earn income through quarterly dividends, typically 3 to 7% annually. That's passive income, baby. You might also benefit from property appreciation. As the value of the properties goes up, so does your investment. You don't deal with any landlord headaches, no late-night calls about leaky faucets or broken appliances. The main downside is liquidity. Your money is typically locked up for months or years. But that's actually good for beginners because it prevents emotional trading. I started with Fundrise at $500 2 years ago. though now you can start with just $10. And I've averaged about 5.6% returns. Not spectacular, but steady and separate from stock market fluctuations. And there you have it. 5 legitimate ways to start investing, even on a tight budget. Fractional shares for getting pieces of expensive stocks, micro-investing apps for investing spare change automatically, I-bonds for safe, inflation-protected investing, index fund ETFs for instant diversification, and real estate crowdfunding for property exposure without huge capital. Here's what I want you to remember. Every successful investor started somewhere. Warren Buffett bought his first stock at 11 years old. He didn't start with millions, he started small, just like you. The habit of investing is far more important than the amount. Starting with $25 a month now and increasing as your income grows will put you miles ahead of someone who waits until they have enough to start. Time is your greatest asset when it comes to investing. The best part? These options eliminate the traditional barriers that kept average people out of investing. No more minimum investment requirements, no more high fees, no more members-only club. Investing is now for everyone, including you. Don't let anyone tell you otherwise. If you found this helpful, hit that subscribe button for more financial education that won't put you to sleep. And drop a comment letting me know which of these 5 options you're most excited to try. I'd love to hear from you. Until next time, remember, your financial future is built $1 at a time.